So goes January, so goes the rest of the year. That's typically the question. That's a classic market trope, and it's one that's going to be one of the themes that we talk about as we begin with our weekly outlook of markets and profile from the team here at TRADEWITHPROFILE.com as part of our profile trading development pathway. Each week, traders on our development desk who are looking to gain skill, to be active in intraday futures, specifically in the ES, NASDAQ, Russell, and Crude, use this video as part of a process. And the process is to review what were expectations of last week versus how the week ahead is. What catalysts were driving the narrative last week? Which catalysts are there? Which key levels are we going to expect behavior around? And which key levels are we going to look at for the coming week? This all helps us give a plan. It's nothing sexy. It's just the work that we do in and week out to make sure that we're aligned with the narrative of the auction and that we are prepared for the work ahead. So with that, we typically always start by taking a look at some macro perspective. And, we are not macro traders or behaviorists, but as behaviorists and as there are participants who are using behavior as a key input, right? I mean, the one fundamental that we trust more than anything else is that behavior and how participants behave at prices is the most insightful insight as far as a fundamental that we can lean on. So what are the kind of the key macro narrative that we have in play? First, we are in a fiscal market. The last 15 years were what we call monetary markets. This is a fiscal market, meaning that the Fed is against equities. One of the first things you learn in markets is don't fight the Fed. And right now, the Fed continues to fight the markets. And so that has led to a lot of the volatility. It's going to be really interesting as we got through our first FOMC last week. Powell speaks again this week. What's also in play? Inflation. Inflation is still at decades highs. It has definitely come down, maybe past the peak, but still elevated. And because of that, we have an equation that is higher inflation over a period of time equals higher interest rates, which we're all experiencing. That equals lower earnings per share, which equals lower prices. And we're in the middle of earnings season, although most of the big earnings plays have already been over. But one of the things that we've seen through earnings is all revisions lower. Expectations revision lower because the impact of higher rates for longer is absolutely going to impact how companies can generate profit. If you're financing operations and your costs of finance go higher, guess what? Your earnings likely are going lower. And so it's definitely a high correlation, something like gravity, right? What else is in play? Interest rates are expected to rise into the fall, meaning that for all of the FOMC meetings that we have from now until we get to the fall, the highest probability is that we're going to continue to get a rate hike. Now, will that be 25 basis points? Will that be 50? Will that be 75? That's less certain. But right now, it's still expected that we wouldn't see potentially the highest probability for the first cut not to come until the end of 2023. So in a Fed for the market, what would be a mark of the Fed coming in aligning for equities? That would be them cutting rates. That's not coming until the end of the year, gang. We're still very, very early. Also, January relief. So people will say, so went January, so goes the rest of the year. Let's look at some charts relative to what happened in January. And I'm going to make an argument that what we really saw was we saw a relief for some depressed asset classes. Okay. So what we're going to do is we're going to go over here and take a look at some asset classes. So we're going to go back out of this real quick. We'll come back to that here in a second. And we're just going to look at this chart here, right here. So let's look over the last year. And this is the S&P 500 with some key sectors that have been in play. And then over the last year, I mean, what did we have? We had energy was really strong last year. Tech was really weak. That's the XLK right here. Consumer discretionary, that would include Amazon, Tesla, right, we're struggling. Real estate struggling. So the names tech, real estate, consumer discretionary were suppressed at the end of last year. In fact, if we go back and take out 2023 or anything for 2023, looking at the last year, you can really see how stretched it was. Look at the last month. Okay. What was high last year? Energy. What was a low performer in January? Energy. What was beat up last year? Tech, consumer discretionary, real estate, right? Which are ones that have all rebounded in January. Okay, these are all the depressed asset classes. Now, does this mean that everybody's going into these because we're rotating into these items? Well, unlikely. And the reason that we're unlikely to do so is because we still have this interest rate problem, and that's going to continue to suppress these. So, most likely, and this is a behavioral characteristic that we see, is that when you see a market that's been going down, any asset, the first push up is not the turn. Okay, that's a relief. Some would call it a dead cat bounce. It's, it could be shorts taking profit. It could be some early opportunistic longs. We've seen that because we've seen that primarily via call buying. We're not seeing a lot of people allocating a lot of cash into these assets, but we are seeing them doing that via options markets as a way to be able to capture some upside pressure, but not really commit long-term dollars in it. So I'm not expecting this to sustain. So as January goes, so goes the year. I think it's a little early for that. But if in my best explanation for, okay, why did we see all of these rotate, is because when you step back and look at the last year and you look at this year coming to the year, the underpriced or undervalued asset classes were the ones that were worth buying. Okay, so that should not surprise anybody that we saw those going higher. As to where that goes for the rest of the year, some of the long-term fundamentals of the higher interest rates will really impact housing. It impacts tech. It impacts consumer discretionary, right? So until we really see a degradation in inflation, until we see the rates coming down, we're likely to see these products start to trade sideways to lower as that narrative is in play. Okay. One other thing that has continued to be in play as far as a macro narrative is just the idea that we continue to see risk that is underpriced. And what do we mean by that? So if I go back over here and look at the VIX curve, which is the relationship to VIX over multiple expirations relative to the SPY, the ETF of the S&P 500, we can really see that all told, we're really just balancing in a range here. We obviously are above the 2022 lows. We've kind of opened and gone straight higher. That's typically pretty nervous for me. A market that just opens and goes higher typically will come back and revisit and then press for lowers later. If a market goes first and takes out a low and then comes in, then I know that I can't go there, and then it will build confidence this way. Especially if that was aligned with the macro narrative. And I think that will happen later in the year. I mean, if that will get lower prices, and then the Fed narrative will come in to say, hey, we're cutting rates, and then that's going to be the rocket ship. I think ultimately is going to be back to these prices by the end of the year. Remember that from our annual outlook, the expected range for the S&P, the SPY, is 472 to the upside and 292 to the downside. So we're still, with 1 month in, still pretty much in the middle of that range. Okay, so still have lots to do, and make sure that my annotation here is working so we can see that. Oh my gosh, it's not working. Okay, well, we'll have to figure that another way. Okay, but what we are seeing, let me just get the annotation tool here. Well, we're struggling here, gang. Hold tight. Hang on a second. We'll get there. Okay. So what we are seeing is we're seeing a curve, a combined curve, that's really in the middle of the muddle. Not too complacent and not too scared. We have inverted several times on the near end of the curve. That's primarily been call buying, not put buying, which is what you'd want to see to get a good sustained bottom. The longer expirations, although we did get a little bit of put buying coming into FOMC, that's now abated, which is giving us some higher prices. And, we're going towards complacency. So, I'm still looking for this lower combined curve to get either to one of these extremes. So the higher extreme, that would be the place that would take us to like a new a bottom we could really rest on. To the low extreme, that would be a pretty significant sell-off. Okay, as you can see, other times when we've been in these areas, that's how that has been in play. So with that being said, we will press on and start talking about the calendar and potential catalysts to watch out for in the week ahead. All right, going over to the calendar here, which you can access on the TWP website whenever you would like. This week, we have Powell on Tuesday. Really, this is going to be the big catalyst for the week. It's a largely quiet week. We had big tech earnings. We had FOMC. We had non-farm payrolls last week. This week, we got Powell speaking. That's going to look for some additional color around what's going on. Crude oil's on Wednesday. WASDE report for grains on Wednesday as well. We do have some other Fed speak later in the afternoon, like Waller's going to speak here. We got some Chinese CPI inflation data. Consumer expectations on Friday, not a deal breaker. So really watch for potential big moves here. Given the fact that we don't have any other major catalysts, we could see a pretty good move off of Powell's speech here. So make sure you mark that down on Tuesday. So as far as the calendar goes, we've got Powell on Tuesday. Wednesday, we've got EIA and WASDE for grains. And then Thursday, jobless claims. Next week, though, we have the next CPI, so next inflation reading, and then we have OPEX. So those are the next kind of big catalyst to pay attention to as we work ahead. With that, now let's go take a look at the S&P 500 and see where we are and what we're expecting in the week ahead. So real quick, a review of what we expected last week. So last week we said, hey, buyers are in charge above 4K. The key reference being 4032. We had FOMC, Apple, Amazon, Google, non-farm payrolls, and expected a range of 3978 to 4189. And if we were above 4K, we were reaching for 4200, which was the achieved expectation. So looking here at a monthly chart, we are... Actually, if we just look at the weekly, because that was kind of a weekly expectation. But above 4032, so here was that key price that we were looking for last week. Above there, we were looking towards 4200. You can see that we hit that. That high expected of the week was 4189. Pretty spot on, right? So that worked really well. We had big push here off of Powell, and then a wiggle and failure a little bit on non-farm payrolls at the end of the week. We did see some pretty good volatility off of the Apple, Amazon, Google release. So that's where this move was, and that as well. But ultimately, the narrative played out about as we expected. As far as the coming week, let's get to the plan for this week. So buyers now control above 4100. With the key reference being 4147. We do have Powell speaking on Tuesday. That's what we're going to watch. The expected range is 4040 to 4025 or 4255. A couple key highlights, all right? And we'll come back to the slide. But we are in a range from 4100 to 4200. So let me go out here to the longer term chart. 4100 right here, essentially, up to 4200. And if I back up a little bit, you can see where we last reflected off of that. So it's a little bit of a micro range. We really kind of broke out from the 3750s up to 3915, and then above that it was to the 4040, and we've just been kind of working our way, cascading through these different ranges, and now we're in the 4100 to 4200. What does that mean? It means 4100 is pretty key for the auction to hold. If we fail at 4100, we open the door to move back towards composite prices that are lower. Okay. So, 39.89 right in here to 4K, that is all pretty massive support. 40.20, in fact, very, very big support. If we go and look at the long-term composite, okay, you can see the 40.20 here. This is a quarterly profile, very much holding that area. That's really key for us. We have essentially achieved the next big hurdle at 4,200. Above that, what's the next spot? That's going to be like 4,350. And we do have, around 4,300, we've got a little bit of a composite low volume node, which can be a spot that we push into and then reject. Now, as for where we are, looking at the composite and looking here at the near-term chart on a weekly basis, knowing that I've got near-term value up here around 41.57, 41.47, midterm value or monthly value down here around 39.89 to 40.20, any higher price will take us into what I call auction extreme, meaning I'm going to look for that to fail. That would put us above monthly expected high, which is up here at 42.91, so close to 4,300. We're close there, but that would put us above 2 standard deviations of the weekly and monthly VWAP. That put us above value. I would expect if we push higher early, we'll ultimately return back to 41.57 because we'll just run out of inventory. The auction will start to it'll push higher, and then if it can't sustain up here, it's going to fail back in this direction, because what will happen is the inventory will just diminish. Okay, and an auction that can't diminish or hold inventory will return back in this direction. However, keeping an eye on the 4,100 area, if we push early first, watch for a test at 4,100, and then see if that takes us back to 41.57 to validate that price. But below 41.50, we are in what's called ping pong land. So we're between composite references of multiple time frames, and the auction can ping pong back to try to see where we rest at one of these two prices. Okay, below 41.50, below 4,100 likely takes us back to this one. So watch this area. Watch the base of the FOMC as kind of a key price. Watch the last week's weekly VWAP. Watch monthly VWAP. Those are going to be key references for the auction as we go higher. Okay, and so that's essentially what our expectation is going to be for this week. So early higher prices take us into an extreme, which is likely to fail back to 41.50 to balance. Below 41.50, ping pong between 39.89 and 41.50, and acceptance back under 4,100 likely takes us back to 40.20. And definitely keep an eye on that 40.20 going forward, because that is our key long-term composite support. We get back below that, and that gets us back into the lower bracket. If we're below 39.89 even, at some point, it puts us on a path back towards the lows of the year. Okay, so that takes care of the ES. Let's now talk about the NASDAQ and see what we were expecting last week and what we expect this week. Okay, so in review, last week, buyers had control above 11,850 with the key reference 11,935. All the catalysts, same as for the ES. Expected range 11,932 up to 12,509. Scenarios, we were in a bracket, but push higher toward 12,500 to 12,800, which could be what we call a test. And that's this, key scenario, and that's the one that played out. All right, let's take a look at what exactly that looked like as we came in to this week. Okay, so last week, or the prior week, here's at 11,935. Here is this week's profile, right? So if we're above that, we're looking for a push toward 12,500. You can see we pushed up there towards the weekly high, and actually pushed above the weekly expected high quite a bit, about 400 points. We almost got to 13,000 before ultimately backing up. Definitely seeing support in the composite VWAPs, but notice here in the profile that 5-day value and even the weekly value VPOC from last week up here, all the composites are much, much lower. So we're now in a position where if we push higher, it's likely going to fail, especially if that comes early. You can see we did get to the kind of the key expectation was to get above the trailing VWAP from last year, very much above the one for this year, and we're doing a good job holding above this big composite range. We want to keep doing that. And when I said test, what I mean is if we test up here and get back inside of this bracket, that will put us on a path down in this direction. I still am carrying forward the fact that we have a pretty bad low or poor low in the auction that is likely to be seen at some point this year, unfortunately. If we go look at the composite or the long-term composite, take into account quarterly profiles, we can see 11,700 is really, really important for the auction to hold. That's most traded price last year. You know, what's the next big node that we're looking for? That's kind of in the 13,250 area. And then above that, we could look towards 13,900. But look at how thin this profile is getting as we're pushing higher. I mean, we really just, the whole month has just been, January was open, close, and February has continued that. We're in the move phase. We're looking for rest. That's the next behavior that is likely to be in play. And so our plan for this week is carrying forward. Buyers above 12,300 is where control is. We do have Powell speaking. You're going to watch that. The expected range is from 12,326 to 12,922. What does all of this look like? Okay, so 12,800. We really want to, be able to hold these higher prices to be able to keep moving higher. If we're below that, then that puts us, between a couple different prices where we can kind of ping pong back. But we really, really want to be careful that we don't get back below here. If we get back below 12,300, then that puts us on a path back lower. So watch and see if we get early tests in this area to push higher. That would be a spot that I would look for, like a pullback, test the top of that bracket, and then push higher. If instead we go higher first, the profile will be very thin. We need to balance and then look for that to fade. So higher early in the week, expect that to fade. Lower early in the week, could test, and if that breaks the test or we get back through FOMC, scene of the crime, then we could be on our way back towards 11,600. But that'd be a pretty big break. I mean, our weekly expected range kind of puts us in this area. Okay, so that would be a pretty big move. Could happen, but that would be outside of the expectations. So overall for this week, if we can test lower towards 12,300, that would be great. If that comes early in the week, then return us back to 12,800 and higher. If we push higher early, then look for them to come back to 12,800 will be the expectation. And again, 11,700, we're not anywhere close to there, but keep carrying that forward. We go back to that price or accept below that price, and 10,750 and lower are likely in play yet this year. Okay, so that takes care of the NASDAQ. Let's take a look at the Russell in terms of what we were expecting in that product this week or last week. We said, hey, buyers are in control above 1885, with the key reference being 1894. We had FOMC non-farm payrolls specifically impacting those products. We're in expected range from 1875 to 1960, and 2000 was the next big target on acceptance above 1894. Failure would return us to 1900, below 1885, and we begin back to 1850 and lower. Well, how did that play out? Here was the let's get to our weekly chart here. So here's that 1890. So we said, hey, above 1894, and we're looking for a push towards 2000. We got to 2000 and some on the way higher and moved the weekly most traded price coming into the week ahead closer to 1993. We'll talk about that here in a second. So definitely achieved that above that key composite. In fact, you can see on the monthly here how much energy there was on the January profile that was really incomplete to the upside. So this is an expression that as long as you're above this composite, we're looking for the auction to keep pushing this way. Now we've expressed that. Okay, so the question is, where to next? What's the expectation now in the Russell? Let's go start first by looking at the long-term composite here. And you can see pretty clearly where the next big target is. And that's right here at 2035. Most traded price at 2022. That's the magnet. I'd expect, that we're eventually going to get there. But definitely, do you see this, gang? Like, look how thin that is. That's sketch. It also means I really, 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 really need to keep holding this area, or else I'm going to go back into the bracket that I just broke out of, right? So now we're basically into the extended bracket, looking for a test up here. And if we get up here, if we can hold above that, then we go towards the next big spot, right? But we'll just kind of watch as we go through these. Should we fail immediately and come back here, then that would open the door to push in this direction. Obviously, that would take some time to play out. But as far as what we're expecting this week, let's kind of zoom in here and look at the plan for this week. This week, buyers above 1885, still controlling from a multi-session basis. The key reference that we're watching is 1939. So you can see the 5-day right here. There's a big node here. You can quite pull it up. I mean, we moved so fast that we have a number of prices that could kind of compete. So depending on your data platform, you may find that the 5-day is a different price. But 1939, 1993, somewhere in there. But essentially, here is the key defense for the auction. So as long as we're above this price, buyers still have the ball. We come back through this, and all of these buyers have been canceled, and that opens the door to go this way. So that's why we're controlling there. We want to see acceptance where we can pull value higher to be able to get up to that 2035 key composite, right? So what does that also mean? That means at 2035, we'd expect the auction to get up here and pause, not just because it's engaging the long-term composite, but also because it's pulling near-term value higher. And for the auction to continue to get higher, we need to have more participants up there. Early pushes up here are likely to invite sellers to bring us into balance where we could kind of ping pong between some of these composite levels. If we get an early liquidation, that tests the top of watch 1930 and 39, but above that, we could test the top of the 1750 to 1915 bracket. There's a big long-term bracket below us. That could be a test, and then we'd push. So early selling, look for them to then defend and do something like this. If we push higher first, then look for the auction to kind of do this deal. And then if we break late, we would be heading back in this direction. Okay, so that's going to be the plan for the Russell. 2037 to 1949 is the expected range. Finally, crude oil, of the products that we look at on a week-by-week basis. Crude is having a bit of a day, or I should say a bit of a challenge. All right, let's review what our plan expectation was for crude last week. One, we said sellers were in control below 80.70, and that had 80.20 as the key reference. We had OPEC release and also EIA, and expected range from 76.22 to 82.54. If we were below 78, we would continue to the larger 74.30 in a 74.30 to 82.50 bracket low. As you can see, where did we do? We checked off that. We essentially played the bracket rules and pushed to the bottom of this bracket. And, if you watched the last couple of weeks, I kept looking for the breakout higher on this poor high, and that didn't work. It's why it's so crucial to know what are the key prices you got to defend. Because if you just keyed in on something like this and got myopic about it, and when we said, hey, 80.20, once you break that and open the door to the downside and have a scenario that if we can't hold up here, we can break in this larger area. We ran all the way to the bottom of this bracket. All right. So now, what's the expectation for where we're headed? Well, let's go look here at the long-term chart and just get a picture of what I think is in play for crude. Okay, so quarterly profiles. Here we are again in a bracket of prices, right? Should we break, this would be a test of the lows at the end of 2022, could put us on a path into this area, which would be like the $65 area, which would be kind of taking back everything from 2022. So I am expecting some lower prices early in the week. Take out last month's lows and start pushing towards the 2022 lows at the end of December. However, noting that, look at the profile here. Look at the 5-day, very, very thin. All of our composite references are higher. So we're actually the 5-day is here. So we're in a extreme posture. If we go and look at the quick sheet, so you see here's we're below the 5-day, and the 5 days below the 20-day. So here's the 5-day, 76.41, 81.18, 90-day at 78.96. So what am I looking for? All right. I also, as we just jammed lower on the close of the week, we're way outside of 2 standard deviations of monthly VWAP. The profile is very thin. So what am I looking for? As I approach, the daily expected low on Monday, I'm looking for any early lower price to get snapped up and look for opportunities to push back long towards the 5-day. I would not even think about being short unless we had happened to open and immediately rallied higher back toward value and then failed. So, or the other alternative to being short this week would be that if we could balance early in the week, build and accept some prices lower, and then push from there, that would be great. However, if we push lower in the week early and then get back inside of this range, then look for the long back in this way. And then if we get back above 76.40, and then that could take us back to 78. 78 being that really, really key long-term composite we talked about last week. That opens the door to go back and get the top of the bracket that I was eyeing a couple weeks ago, right? So right now we've got our expectations a lot lower. But as far as like what we're looking for this week, the plan is that, hey, the sellers have control below 78. 76.41 is the first key reference. We have EIA on Wednesday, expecting 70.47 to 76.31 from the options market. A new 2023 low is in view. We're approaching monthly expected lows. We're in extreme posture. That means that we're not chasing short. We're looking for opportunities to be long back toward the 5-day, 76.42. If we get above 76.41 by the end of the week, then a push towards 78 would be in play later as we go. Okay, so that is all of our kind of key products that we're looking for, and we'll do updates on the daily outlooks for everybody on the team each day. Those will also be the ones we'll be exploring in Slack. It's not the only things that I look for in opportunities. So some other ideas that are in focus this week, in the week ahead, that I'd like to review. So first, just some open trades and positions that are in play, just some updates on some of these. I've got some long stock here. FCX is a kind of inflation copper play. Ford is also an EV play long term. ES, I do have a short butterfly. It's a low risk trade in case we fall out of the bed towards March, holding that. The ES NASDAQ spread, okay? I want to look at this one because this is one I had been talking about for a while. Let me get to the right chart. And we're just about out of this one. So looking, when we started the year, or at the end of 23, and you look back, see the divergence between the NASDAQ and the ES. When you're very correlated products, expecting those to come back together. And now as we come back to now, you can see that the strength of the NASDAQ has closed the gap. And so those have come together. What that looks like, just an idea from a P&L standpoint, if you're just looking at actually that's the wrong one. Let's do this one. From the low down here, and this would just be on a one lot mini trade. Okay. The low and the spread between that was $58,000. That has now come up 20K on a one lot mini. Okay, so just give you an idea of what that trade in closing the gap from here to here translates to when you convert that into the tick values of those products. That's a relative value spread. That's done really well, so not going to be tracking that one much longer. I had a Tesla long butterfly that I closed off of the ramp there. I do have a micro NASDAQ short that I have not done anything with. I'm really just kind of waiting to do some work on that. And then finally, I've got a Bitcoin long that we talked about last week. So let's go look at that trade. We've essentially got to target one. The key idea there was that we were in a bracket or testing a bracket and push below, and that when we get back inside the bracket, we were looking for a test across that defending the low. Target one is up here at 25K. If we can get above 25K and hold, then that could take us toward higher prices. So that one is almost done. Going to get really, really tight on the risk, keeping it towards the upside of the bracket. See if we can get a breakout test to the upside on that one. So that's open ideas. Now let's talk about some active ideas for the coming week. The first one, now this is just an illustration, not illustration, but a further discussion of what we talked about with crude oil, given where we are from a posture. A couple different ways you can play that. One is you could do a macro profile swing. Well, that basically means you're trading more narratively. You know the key target. You're looking for that 76.42 on a failure lower, and then you'd look for sellers to get trapped and look to push back up towards composite value there. Another way you can do that via options is do an exhaustion straddle. You know, hey, look, there's a price that we're likely going to need to balance around, which would be near that 76.42. Sell the put and the call at that strike price. And, you know, as the auction, you know, tries to balance, or maybe even a strike just a little bit below that, because we've moved, we're now expecting balance and sideways trade. You can sell that straddle, sell the call and put at the money, and then let that thing collapse. Is a different way to play that. I am looking at Meta. So Meta showed up, just reported earnings. And if we see early higher prices in Meta, you can see a couple different nodes here. A couple different ways to do this. You could sell call spreads above the market. You could also do an exhaustion strangle where you're or straddle where you're basically selling a pocket and you're expecting it to trade sideways here. Or you can do a put debit spread, buy the debit spread to push back in this direction. I kind of like either selling the call spread above it because we just got through earnings, so the implied volatility is a little bit higher. You can get some pretty good premium, you know, because it's going to be, I think, a stretch for Meta to get up there. 210, 220 would likely be the strike that I'd be defending, you know, or sell that at the money straddle. So we'll see how that plays out in prices to begin the week. And then the ES, also looking for a macro profile swing short. So looking for some short deltas in that, you know, towards 41.57 or 3,900 if I get above 4,200 and reject. So in that narrative of if we go push higher first in the week and then fail, I'll be looking to be short the ES there. And then the last one, I said we had WASDE in grains. And so I'm looking at the soybeans, which is a balanced product here. And there's a big note here at 15.15. Now, if we back up and look at the larger picture, you can see that soybeans have actually moved pretty good from, you know, kind of 9-month value at 14.48. But essentially what we're looking for is off the WASDE. We're looking for them to go up toward 16 or down back in this direction. Either way, we're looking for a move. And so buying the at the money straddle, in spite of the WASDE, the IV is low, hence the idea around the straddle. So it's a couple ideas. Doesn't mean I'll execute on all of them, but these are ones that I'll definitely be looking at each day and see if there's good entry criteria, and then we'll update on how they did at the end of the week. All right. Great. Last thing to cover before I let you go is a development focus. And, you know, since we did get to the end of January here, great question is, two questions actually to ask yourself is, hey, what's working and what's not working? It's a great introspective question to always ask in any endeavor. It doesn't just have to be markets, but you could say, hey, how are things? What's working? What's not working? Actually, just get 2 columns and write them out. Now, here's the kicker on this: is that there could be things that are not working that actually are working, and there could be things that are perceived to be working or not working and are things that you believe that are working and are not. So requires a little bit more perspective. But one, solidify around what's working. You know, okay, if there's something working, there's a specific product that seems to work that you're investing around or trading around. If there seems to be a certain time frame, a certain time of day, get as much data as you possibly can around why is it working in what's working. Why is that important? Because if dynamics of the market shift, you need to know what those things are that may now stop working, right? Have curiosity around what's not working. The idea of style drift often happens, especially if you're kind of a DIY retail trader. There's so many ideas and indicators and different stuff that you want to try. And you likely, if you've been around this long enough, several years, have already gone onto something that is effective, but because it didn't work for you in that specific context, you've thrown it away and said, well, there's nothing for me there. That's actually not great because there may be a better context where it's very, very effective, and you just happen to be in the context when it wasn't effective. And if you approach it again, it would be really, really helpful for you. So just do that with curiosity and just say, okay, what's not working? And why do I know it's not working? And is there some other condition that would help it to work, that would give me better insight? This even goes to the idea of, how many indicators should I have in my charts? I always think that indicators are like makeup, meaning, how much makeup should you have on your face? It depends on your face. If you need it, dab it on. So if there's an indicator on your chart that helps you make a decision, use it. If you go back and review your charts and you can't find a single decision that you made because of anything that's on your chart, now's the time to get rid of it. And that's a great month by month practice. You just look at your charts and say, okay, did I use everything on this chart to make a decision? If I haven't, I'm going to take it off. I'm only going to keep the things on here that help me make decisions, because I don't need noise. I don't need things complicating an already challenging deal. Finally, where do I need some help? That can be just for yourself. It's just, hey, where do I need help? Where do I need some additional insight? What kind of questions do I want to ask? There's lots of great practitioners out there offering Q&As. We do skill sessions over time. For those of you who are in the pathway, these is what our weekly Q&As are for, is to be able to say, hey, here's the area where I need some help. And then also remember the 4-room model of change. And the 4-room model of change is the idea that everybody is in one of 4 rooms with any endeavor. Okay. Oh, I did that pretty poorly, didn't I? So let's imagine all right, you're in one of these 4 rooms with respect to your approach to markets. And what are these rooms? Well, the first one is contentment. The next one is in denial. The next one is in confusion. And the last one is renewal. Okay? Which one are you in? And then the question after that is, how will you know when you're moving from one to the next? So if you're really content with how January went, that's awesome. Guess what? You need to say, well, what will be clues for me that I'm missing something, that I'm in denial about my skill, right? I mean, this happened. There were traders who started in 2020 who killed it, who are now not even active anymore, right? Why? Because they were in absolute denial, even though they were doing really well. They didn't have skill they thought they had, okay? So it's a great thing. We always have to have a way to know which room are we in, and just reflectively say, how will I know? What would be the markers that I'm moving from one room to the next, right? Use that 4-room model. It'll help you out. Finally, some other ways to help you build skill this week. You can do that. Learn the 4 questions. Make sure that you're using the 4 questions whenever you're looking at an opportunity. Follow along on Twitter. Schedule an insight session. There's a link to this video and also on our website where you can have a 30-minute conversation. We'll take a look and see where we can help. If you're not part of our development desk, do that via one of the pathway options. A number of ways to engage that. If you're curious about the software that you've seen us use, we use windowtrader.com and edgeclear.com, Edge Pro X, 2 great platforms to help us arrange the auction information so that we can see what we need to see and make better decisions. And finally, for those of you who are working through the pathway, we'll see you in Slack this week and in our development sessions. Should be a pretty great week that we're not working around these big catalysts. Got a few, but not a whole lot, so it should be fun, right? Hey, thanks for watching. Hope this has been helpful for you and give you some insight into just what it looks like on a week-by-week process to approach markets. Not very sexy, but man, you have a process like this week in, week out, and the results will they'll speak for themselves. Hope you have a fantastic week. Trade well, mind your risk, use the 4 questions whenever you're about to put on a trade and see if that doesn't help you make better decisions. And then if this has been helpful to you and giving you some insight, we'd love to hear about that. Thanks for watching. We'll talk to you next week. Peace.